Hey, wealthy business family, today we're talking about a major development from the Swiss National Bank. For the third time this year, the SNB has cut its key interest rate, bringing it down by 25 basis points to 1%. This move has raised some interesting questions about the Swiss economy, inflation, and even deflation. So what does it all mean? Let's dive in. This latest cut wasn't a huge surprise. In fact, 30 out of 32 analysts in a Reuters poll predicted this move. But here's where it gets interesting. Inflation in Switzerland remains quite low, with just a 1.1% annual increase in August, far below what we're seeing in other countries. SNB Chairman Thomas Jordan, who is set to leave the central bank at the end of this month, mentioned that more rate cuts could be on the way. He said that it might take additional policy easing to stabilize inflation within Switzerland's target range, but he stopped short of saying how many cuts would be necessary. The SNB also slashed its inflation forecast. For 2024, inflation is expected to average 1.2%, and even lower for 2025 and 2026 at 0.6% and 0.7% respectively. This is a major revision from their June forecast. Part of the reason for this drop? The strong Swiss franc, which has gained ground against major currencies. So why is the franc getting stronger? Well, it's largely due to global economic conditions, lower oil prices, and even electricity price cuts coming next January. But a stronger franc also creates challenges for Swiss exporters, making their goods more expensive abroad. One of Switzerland's largest industry groups, Swiss Mem, has called on the SNB to act because businesses are feeling the squeeze. While the franc's strength is helping reduce inflationary pressure, it's hurting industries that rely on exports. Now here's where it gets a bit tricky. Some analysts are wondering if Switzerland could be heading toward deflation. Yes, deflation. Unlike most Western economies that are struggling with high inflation, Switzerland's low inflation and strong currency are raising concerns about prices actually falling. But Chairman Jordan pushed back on this, saying that the risk of deflation is minimal, and the SNB is focused on keeping inflation within the target range of 0 to 2%. However, if necessary, the SNB has other tools at its disposal, like intervening in foreign exchange markets to stabilize the franc. So, what can we expect next? The SNB's next big move will likely come in December when they release their updated inflation forecast. And with a strong Swiss franc and global economic uncertainties, more rate cuts could definitely be on the horizon. To summarize, the Swiss National Bank cut rates to 1% for the third time this year. Inflation remains low, but analysts are questioning if deflation could become a risk. The strong Swiss franc is both helping inflation but hurting exports. More rate cuts could come as soon as December or March. So, what do you think? Are we going to see further rate cuts, or will the Swiss economy stabilize? Let us know in the comments below. And as always, if you found this video helpful, make sure to like, subscribe, and hit that notification bell for more insights from Wealthy Business.